If you study history long enough, you begin to hear echoes. What we're seeing in today's markets is not new. It's a modern variation of an old and repeating story, and one that doesn't end well for those who ignore the signs. There's a fundamental truth about markets and economies that most people overlook. The patterns we're living through today are not new. They're reflections of cycles that have played out over and over again through history. The details change, technology advances, political figures shift, the headlines differ, but the underlying mechanics of boom and bust, of debt accumulation and deleveraging, of fear and greed remain consistent. When you study long-term history across countries and centuries, you begin to see that economies operate in cycles, and these cycles are primarily driven by human nature, our tendencies to overextend during good times and panic during bad ones. It's that simple and that complex. What we're seeing in today's U.S. stock market resembles what has been seen many times before. Excess liquidity, ultra-low interest rates, speculative buying, and a growing disconnect between asset prices and real economic productivity. These are not new phenomena. They have occurred in different forms during the Roaring '20s, the dot-com bubble, and the housing-led boom prior to 2008. Each time, optimism about the future created complacency in the present, and each time the cycle eventually corrected, often violently. Debt plays a central role in this pattern. During the expansion phase of a cycle, borrowing increases because credit becomes cheaper and more accessible. People feel richer, so they spend more. Companies borrow more to invest in growth or to buy back stock. Asset prices rise, confidence builds. But debt is a double-edged sword. It pulls future spending into the present. Eventually, when incomes don't rise as fast as obligations, the ability to repay becomes strained. Defaults rise, spending slows, and then the very fuel that powered the boom becomes the fire that feeds the bust. This is not conjecture, it's how credit cycles work. It's been this way for hundreds of years in many parts of the world. The Dutch in the 1600s, the British in the 1800s, the Americans in the 1920s and early 2000s. We keep repeating the cycle because we forget what the last one taught us. Time passes, people change, and the lessons fade. Today, the U.S. is in a late cycle phase. We see record high debt levels, not just corporate, but sovereign and household. Interest rates have been kept historically low for years, which has distorted capital allocation. Risky investments have been mispriced because the real cost of money has been artificially suppressed. That leads to bubbles. First in stocks, then in real estate, sometimes in both. We've seen this movie before. What's particularly dangerous now is the complacency. Many investors assume that central banks will always be able to bail out markets. That assumption is rooted in recent memory, what happened in 2008 and again in 2020. But the ability of monetary policy to fix deep structural problems is limited. You can't print productivity, you can't lower interest rates below zero forever and expect long-term stability. At some point, those tools lose effectiveness, or worse, they become part of the problem. Another part of the repeating pattern is what happens socially and politically when economic imbalances grow. When wealth gaps widen and opportunity feels scarce, tensions rise. Populations become more polarized. Extremes start to look appealing to people who feel left behind. This too is historical. It happened in the 1930, and we're seeing versions of it again. So the big picture is this: while markets may look different on the surface, the deeper dynamics at play, the ones that truly matter, are repeating. The specifics change, but the themes do not. People chase returns when things are going up. They borrow too much. They think the good times will last forever. and then something changes, liquidity dries up, confidence cracks, and the downside of the cycle begins. If you understand that history is not linear but cyclical, you begin to view markets not with fear but with clarity. You prepare not because you know exactly when the top will come, but because you know the top always does. You hedge not because you're pessimistic, but because you respect the risks of the cycle turning. This perspective doesn't mean avoiding opportunity. It means navigating it with humility. It means understanding that what looks safe now might be risky later, and what looks unpopular now might prove wise in the long run. History teaches us that the majority is often wrong at key moments. The crowd tends to get excited near the top and afraid near the bottom. Recognizing historical patterns doesn't make the future predictable, but it makes it navigable. And in times like these, that can make all the difference. What often feels stable in the moment is more often than not just the calm before the storm. Markets and economies don't move in straight lines. They oscillate between extremes. And yet, during those extended periods of calmer growth, people come to believe that the conditions they're experiencing are not just normal, but permanent. That's where the danger lies. The greatest risks are often the ones people don't see, not because they're invisible, but because they're being ignored. Stability, as perceived by most market participants, is often based on surface level indicators, stock market performance, GDP growth, low unemployment. But these indicators are lagging. They reflect the past more than they reveal the future, and they rarely account for what's happening beneath the surface. In today's environment, this illusion of stability is particularly strong. The U.S. stock market continues to post historically high valuations. Asset prices across equities, real estate, and even some alternative markets have been inflated by a prolonged period of cheap money. The longer this goes on, the more people treat it as the new normal. But what's perceived as strength is often just fragility covered in optimism. Debt is a core component of this illusion. Over the past decade, credit has been cheaper and more accessible than almost any time in modern history. This has encouraged behavior that wouldn't exist under more disciplined monetary conditions. Governments are borrowing at unprecedented levels, believing that the cost of servicing this debt will remain manageable indefinitely. Corporations have loaded their balance sheets with leverage to boost short-term profits through stock buybacks and mergers. Consumers, too, have become increasingly comfortable with debt as an enabler of lifestyle inflation. But none of this is sustainable. Debt isn't income, it's a claim on future income. And when the growth in debt outpaces the growth in productivity and real income, the system becomes inherently unstable. For a while, it feels fine until the payments come due or rates go up or the economic engine slows. That's when the illusion breaks. Central banks have played a central role in creating this environment. Their intentions have been to support economies and stimulate growth, especially during times of crisis. But over time, those interventions have become expected. Markets have become conditioned to believe that whenever volatility arises, liquidity will be provided. Whenever valuations drop, stimulus will follow. This belief has created a complacency that is both widespread and dangerous. The problem is that monetary policy has diminishing returns. You can only lower interest rates so far. You can only inject so much liquidity before it begins to distort price discovery. When prices are no longer determined by fundamentals, but by policy decisions, the system stops functioning as a market and starts resembling a managed mechanism. And managed mechanisms often look fine until they suddenly don't. One of the most dangerous consequences of this illusion is mispricing of risk. Investors chasing yield in a low rate world begin to accept more risk for less reward. They shift their portfolios further out on the risk curve, often without fully understanding the implications. Leverage increases, exposure to volatility increases, and worst of all, confidence increases. People begin to believe that risk itself has been reduced or eliminated, but it hasn't. It's just been masked. There's also a geopolitical dimension to this illusion. As the world becomes more interconnected, fragilities in one part of the system can quickly affect others. Political fragmentation, rising populism, and global power transitions are building pressures that don't show up on earnings reports or balance sheets, yet they're real forces that can disrupt economic stability. And the longer those tensions are ignored or downplayed, the more disruptive their eventual impact is likely to be. It's easy to confuse quiet with safe, but in historical cycles, extended periods of low volatility are often precursors to major breaks. The system becomes fragile not when things are visibly broken, but when everyone believes they're unbreakable. This is the phase we're in now. The prudent response is not panic, but preparation. It means recognizing that things may look stable while being inherently imbalanced. It means asking not just whether current conditions are favorable, but whether they're sustainable. And it means understanding that markets can go from calm to chaos faster than most people can react. The people who navigate these transitions best aren't the ones trying to time the peak. They're the ones who understand that stability isn't the absence of risk. It's often the buildup of it. They prepare, not because they know exactly when the shift will happen, but because they know it eventually will. In complex systems, stability is often self-defeating. The longer it lasts, the more risk builds beneath it. And when the illusion finally breaks, it's usually not a gentle correction. It's a rapid recalibration. The best time to think about that reality is before it becomes unavoidable. Monetary policy has long been the primary tool for managing economic cycles. When growth slows or crises emerge, central banks step in, they lower interest rates, inject liquidity, and attempt to stimulate borrowing and spending. For decades, this playbook has worked well enough to restore confidence and push markets higher. But just because a tool has worked in the past doesn't mean it will work indefinitely. Every tool has limits, and we're reaching those limits now. For years, central banks have operated under the assumption that they can control economic outcomes through the manipulation of credit conditions. By lowering rates, they encourage consumption and investment. By raising them, they cool overheating. In theory, this should allow for a smooth ride, but in practice, the system is more complex, and these levers lose power over time, especially when they've already been pushed to their extremes. Today, interest rates across developed economies are near or below zero in real terms. That means central banks have very little room to maneuver when the next downturn hits. In previous cycles, cutting rates by 400 to 500 basis points provided meaningful stimulus. Now, with rates already at the floor, that option is gone. You can't cut what's already near zero. And once you're in that position, you've used your most powerful tool without solving the underlying problems. Quantitative easing, the next tool in the box, has been used extensively since the global financial crisis. Central banks have bought trillions in government bonds and other assets to keep long-term interest rates low and inject liquidity into the financial system. At first, this provided necessary support, but over time, it began to distort markets. Asset prices rose, not because of improving fundamentals, but because of excess liquidity and suppressed yields. This drove investors into riskier assets, not because they became better, but because everything else became less attractive. The result is an economy where valuations are inflated, borrowing is excessive, and capital allocation is distorted. Businesses that should have failed were kept alive by cheap money. Governments have run record deficits under the assumption that central banks will continue to finance them. This creates a feedback loop that looks stable for a while, but is inherently fragile. The deeper problem is that monetary policy can't create real productivity. It can't manufacture innovation, fix structural inefficiencies, or build competitive industries. It simply brings forward demand. It's a tool for timing, not transformation. And when it's used too often, it becomes less effective. Markets begin to expect intervention. Risk-taking becomes excessive because there's always a belief that the central bank will step in. This moral hazard creates bubbles, and bubbles inevitably burst. There's also a political dimension to these policies. As central banks expand their balance sheets and interest rates remain low, wealth flows disproportionately into financial assets. That benefits those who already own them, typically the wealthier segment of society. Meanwhile, savers, wage earners, and retirees with fixed incomes fall behind. This contributes to widening wealth gaps and rising social tensions, which then feed back into political instability. And when politics begins to influence economic decisions rather than the other way around, objectivity and discipline decline. Eventually, the limits of monetary policy become visible, not in an announcement or a headline, but in the failure of the expected outcomes to materialize. Growth slows despite stimulus. Inflation rises in places where it's least welcome, like energy, food, or shelter, while remaining subdued in wages or real economic output. Investors stop responding to central bank signals as they once did. The confidence that once fueled markets begins to erode. And with that erosion comes volatility at that point. The burden often shifts toward fiscal policy, government spending, taxation, and regulation. But fiscal policy is slower, more political, and harder to coordinate. And if monetary policy has already inflated asset prices and enabled reckless borrowing, fiscal policy becomes more constrained as well. This is where judgment, foresight, and humility become essential. Blind reliance on past tools can lead to future crises. Recognizing the limits of monetary policy doesn't mean abandoning it altogether. It means understanding its place within a broader framework and knowing when it's no longer enough. To navigate what's coming, policymakers and investors alike must look beyond rate cuts and liquidity injections. They must focus on real productivity, sustainable debt levels, and diversified, balanced approaches to risk. The era of easy solutions is ending. The path forward will require more than monetary muscle. It will require a clear-eyed understanding of where we are, how we got here, and what tools still have real power. In a world where monetary policy has done all it can, the next chapter must be written with different instruments, grounded not in illusion, but in resilience and realism. That's the only way to build something sustainable when the old answers no longer apply. One of the most consequential forces shaping the future is the shift in global power dynamics. These shifts don't happen suddenly, and they're not typically triggered by a single event. They evolve over years, even decades, quietly building under the surface until they're impossible to ignore. What we're witnessing today is the gradual erosion of a long-standing world order and the emergence of a new one. Every global system has a cycle. A nation rises to dominance by becoming productive, competitive, and financially strong. It builds institutions, influences global trade, and shapes the rules of the system in its favor. Over time, this dominance is often accompanied by reserve currency status, military strength, and political influence. But history shows that no empire stays at the top forever. Eventually, the internal strength that fueled its rise gives way to complacency, debt accumulation, internal divisions, and external challenges. As that happens, new powers emerge, more driven, more disciplined, more aligned. This is a phase we're now entering. The post-World War II order, largely shaped and led by the United States, is being tested from multiple directions: economically, politically, militarily, and culturally. The balance of power is shifting, not abruptly, but persistently. One of the most significant drivers of this shift is the relative decline in U.S. economic dominance. Decades of deindustrialization, mounting debt, and rising political polarization have weakened the foundations of U.S. leadership. While the U.S. still holds a position of considerable strength militarily, technologically, and financially, its trajectory is being challenged by structural problems that are becoming harder to ignore. Internally, rising inequality, political fragmentation, and deteriorating trust in institutions are symptoms of deeper imbalances. At the same time, other powers, most notably China, have been rising. China's economic growth over the last 30 years is unparalleled in modern history. It has transitioned from an agrarian economy to a manufacturing superpower and now aims to lead in areas like artificial intelligence, clean energy, and digital infrastructure. Its growing influence in global trade, finance, and geopolitics reflects a deliberate long-term strategy. This isn't just about one country rising while another declines. It's about a broader shift from a unipolar world to a multipolar one. Countries across Asia, the Middle East, and even parts of Africa are becoming more economically relevant and geopolitically assertive. Alliances are being reconsidered, supply chains are being realigned, and spheres of influence are being redrawn. With these shifts come rising tensions. History shows that the transition from an existing power to an emerging one is rarely smooth. When a rising power begins to challenge the incumbent's dominance, especially in trade, technology, or military presence, conflict becomes more likely. That conflict doesn't always take the form of war. It often starts as economic competition, currency disputes, ideological differences, or diplomatic standoffs, but the risks grow as interests diverge and mutual trust deteriorates. In parallel, global institutions that once provided stability, multilateral organizations, trade agreements, financial systems, are under strain. Their effectiveness is being questioned. Their rules are being challenged. As alignment breaks down, uncertainty rises. Markets, which rely on clarity and order, become more volatile in these periods. Another component of the shift is in currency dynamics. The U.S. dollar has enjoyed reserve currency status for decades, providing the U.S. with a unique advantage, the ability to borrow and spend in its own currency on favorable terms. But when debts pile up and the value of that currency is undermined by monetary and fiscal excesses, its desirability can decline. That opens the door for alternatives, regional currencies, digital assets, or new reserve systems. It's important to see these changes not as predictions, but as probabilities informed by historical patterns. The rise and fall of empires is one of the most consistent long-term trends in navigate a world that is changing in fundamental ways. Power is moving. The question is whether we're prepared to move with it or be caught off guard by its momentum. In a world full of unknowns, the only certainty is uncertainty. Markets fluctuate, economies cycle, policies shift, events happen that no one sees coming. And yet the most common mistake investors make is assuming that what has worked will keep working, or that what feels safe actually is. This is why diversification is not just a strategy, it's a necessity. Diversification is about not having all your eggs in one basket. That much is commonly understood, but what's less understood is that most investors are far less diversified than they think. They may hold dozens of stocks or multiple funds, but if those assets all respond similarly to the same economic forces, say rising interest rates or slowing growth, then the portfolio is still concentrated in risk. True diversification means owning uncorrelated assets that perform well in different environments, not just different names on a brokerage statement. The economy moves through cycles. Sometimes growth is strong, sometimes it slows. Sometimes inflation rises, other times it falls. Over time, you can classify the environment into four distinct quadrants: rising growth with rising inflation, rising growth with falling inflation, falling growth with rising inflation, and falling growth with falling inflation. Most portfolios are heavily tilted toward just one or two of these conditions. Typically environments where both growth and inflation are stable or improving. But when the environment shifts, as it always does, the same portfolio that once seemed strong becomes vulnerable. This is where the concept of risk parity becomes critical. Most portfolios are built around capital allocations, how many dollars go into stocks, bonds, cash, or alternatives, but capital is not risk. A portfolio that's 60% stocks and 40% bonds may look balanced on paper, but most of the risk is actually concentrated in equities. Equities are inherently more volatile and sensitive to economic cycles, so they dominate the portfolio's behavior. Risk parity flips this approach. It allocates based on risk contribution, not capital. It balances the portfolio so that each component contributes equally to the overall risk, rather than allowing one asset class to dominate the outcome. This creates a more stable return stream over time, especially across different market regimes. And done properly, risk parity enables a portfolio to be resilient, not just in boom times, but during recessions, inflation shocks, and policy shifts. Of course, diversification and risk parity aren't about maximizing short-term returns. They're about compounding wealth reliably over the long term. In the short run, concentrated bets can outperform, but they can also implode. Over decades, the winners are not the ones who bet big and win once. They're the ones who don't get knocked out by what they didn't see coming. The real world is messy. There are always unknowns, black swans, policy mistakes, geopolitical tensions, technological disruptions. You can't predict these events with precision, but you can prepare for them. That's what diversification does. It creates robustness. It accepts that you won't always be right and builds in the assumption that you won't need to be. Most people don't think about risk until after it shows up, but by then it's too late. Capital preservation is harder than capital appreciation because it demands discipline, humility, and foresight. The goal isn't to avoid all losses. That's impossible. The goal is to avoid devastating ones, the kind that set you back years or take you out of the game entirely. It's important to remember that correlations change. Assets that are uncorrelated in normal times can become highly correlated in crises. This is why stress testing a portfolio under different scenarios, rising rates, stagflation, currency devaluation, liquidity shocks, is so important. It helps reveal hidden vulnerabilities before they're exposed by the market. Building a resilient portfolio also requires acknowledging your own limitations. No one knows exactly what's going to happen. Forecasting is useful, but it's never perfect. That's why the best approach is to not overly rely on any single view. Diversification is the recognition that rather than trying to be right about one thing, it's better to do well across many things. Risk parity and true diversification aren't just theoretical concepts. They're survival tools in a complex and rapidly changing global system. They reflect a respect for uncertainty, a recognition of how markets really work, and a commitment to long-term thinking. They help investors stay grounded when emotions run high and cycles turn against them. In investing, as in life, the key is not to avoid risk entirely, but to manage it intelligently. Spreading risk across independent sources of return is the most powerful way to protect and grow wealth in the face of an unpredictable future, because when you don't know what's coming next, and you rarely do, the best position to be in is balanced, flexible, and prepared. History doesn't repeat itself exactly, but it rhymes. And right now, the rhyme sounds uncomfortably familiar. Markets won't sound alarms when shifts begin. Changes will be subtle, then sudden. This isn't about fear, it's about awareness and intelligent preparation. Because when the tide turns, and it always does, only those who anticipated the storm will remain standing. Thank you.